What we're looking at here, of course, is the basic structure of a 14-day free trial to PowerOptions. For those of you that are just getting started, maybe just started your 14-day free trial, I encourage you to take advantage of the 4 steps that are listed. You can grab that quick start guide in the PDF form. There's a variety of flash tutorials to help you get familiar with the site. You can join us for our live webinars, but at any time you can also click the free webinars section here to see our archives on the PowerOptions tools, options strategies presentations, options concepts, and all of our Friday sessions are recorded under the requested topics tab in that free webinar session. And of course, if you're a trial member subscriber, you can schedule one of those free coaching sessions at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you might have. Whoop. Okay, let's make sure I'm showing the right thing again. Screen's jumping around. There we go. Okay, so we do have a few comments that have come in. Sam says hi to everyone in the room. And let's see here. Hello, Sam. Good to see you, too. You said you're making money after all in Lyft. You're doing an 80-85 bear call spread right now on Lyft after that IPO. Fantastic. And the other comment to you, Sam, yeah, I'm not sure what happened there, but one of our regular attendees we haven't heard from in a month or two. So I'll check on that and see if they're still around. I know they're still using the system. I just haven't seen them on the webinars recently, so I'll take a look at that. Oh, Larry posed a question. It's a good question, and it's going to lead me to another discussion that I just had recently as well. So Larry's question is, using PowerOptions, using our system, can one determine over-underpriced option if the option is over or underpriced? The answer is yes. And he's a former subscriber who is just returning from being laid off due to major surgery. Oh, that's a shame, Larry. I'm sorry to hear that, but I'm glad to see you're back. Okay. So there are a few ways to evaluate if the option is overvalued or undervalued. And what I'm going to do first, Larry, is I'm going to go to the chain here. I'm just going to pull up a chain on Disney, DIS. And we're just going to look at a full option chain, but what I want to do is go to somewhere out in time. Let's just go to June for the time being. And here we have the breakup of our calls. The stock's at 114.90. Let's take a slightly in the money 105 call. And I'm going to change it to just the call chain for the time being. Now here I've added more columns, and there's percent in the money, time value, probability, delta, and so forth. What's interesting here, one of the columns I have selected on this chain is the Black-Scholes value. The Black-Scholes value tells me what the option should theoretically be worth based on essentially the current volatility of the stock. Now in this case, looking at our 105 strike, the current price is 1140 to 1160, and we have a Black-Scholes value of 1036. So based on the Black-Scholes pricing model, we can see that this option is overvalued. That's one of the ways that you can search for overvalued or undervalued options in PowerOptions, is you'll see the Black-Scholes ratio, or BS ratio, which you might think means something else, but it's referring to the Black-Scholes ratio. Now, what is the Black-Scholes number? Well, as I mentioned, it's the theoretical price of the option, where the option should be priced based on 5 factors: the stock price, the days remaining to expiration, current sort of interest rate on the market, and then, of course, the main factor is the volatility, not the implied volatility of the option, but the volatility of the stock. And, of course, you know, the range in the money and so forth, intrinsic value. So those 5 factors are taken into account, and it plugs out a number and says this is where your option should be priced. Now, the implied volatility of the option is essentially taking that equation where we have 5 factors for the Black-Scholes on the right and the answer for what the theoretical value should be, let's say, on the left, or vice versa. Then what do? We know that the price is actually different. It's not at 1036, so we replace the answer with the midpoint 1150 and work the equation backwards to solve for volatility, and that gives us the implied volatility. Okay, so very quickly, that's the Black-Scholes ratio. Let me look at the research tool for Disney very quick, Larry. I just want to see something here. Let's get a good gauge. The 50-day volatility is 15, 0.15. This research tool shows us all of the fundamental, technical, and other data that we have for the particular stock, including earnings date, last dividend, and more. Okay, now I wanted to go there first. So now we're going to do that same thing with the option. We're going to look at the call research tool, which gives you all of the calculations and information we have for this specific option, delta, gamma, theta, and more. Now, as we mentioned, we saw the Black-Scholes value should be at 1036 for this option. It's too far over the page, I apologize. But it's 1036, and it's currently priced at 1150 midpoint. I'll put it over here, 1036. Now, just based on the Black-Scholes value, the Black-Scholes ratio, that tells us that it's overvalued. Now, there's different numbers here. There's different ratios that you see on this screen. And I'm not going to try to overcomplicate it, but you have the standard Black-Scholes. There's our 1036, and the Black-Scholes ratio is 1.10. What does that mean? That's telling us that the option is 10% overvalued compared to its theoretical worth. We're trading at 1150. It's about 1036, so it's about 10% over. Another common factor is we showed how the Black-Scholes ratio relates to uses the historical volatility of the stock, but then it works backwards to calculate the actual implied volatility, which in this case is 0.24. Remember, the historical volatility was 0.15, so this volatility is higher for this June 105 option. And the IV-HV ratio here is 1.7. Okay, so in theory, that says compared to its historical volatility, the current implied volatility of this option is 70% higher. Those are the two ways, typically, that an investor will use to determine if the option is overvalued or undervalued. If you have a Black-Scholes ratio of greater than 1, as we do here, that means the option is overvalued compared to its theoretical worth. If it's less than 1, it's undervalued. Same with the IV over HV, the implied volatility of the option to the historical volatility. IV-HV ratio of greater than 1 means the option is theoretically overvalued. The implied volatility of this option is higher than the stock volatility. Now that we've described that basic part, not basic, how do you use it? Well, very simple. In most of these single option strategies, long calls, long puts, covered calls, naked puts, and so forth, we'll just go into the search for long call, and in theory, what do I want? Well, if I'm buying an option, I'd want to see an option where the IV-HV ratio would be less than 1, blank to 1, or where the Black-Scholes ratio, again compared to the 50-day, is less than 1. In theory, when I'm selling, I want it to be greater than 1, don't I? Okay, but that's how you could set up search. You could use the Black-Scholes ratio, 50-day, or the IV over HV, the options implied volatility over the historical volatility. Now, you probably all saw another number there that I didn't cover when we were on the call research page, and that's this IV over SIV, or Black-Scholes ratio of SIV. What is SIV? HV, historical volatility, refers to the stock, whether you use a 20-day, 50-day, or 100-day. IV, of course, refers to the implied volatility of the specific option you're looking for. SIV is the stock's implied volatility. It is the average of the in-the-money and at-the-money calls and puts, the average implied volatility of the in-the-money and at-the-money calls and puts for, let's say, the next, I believe, 30 days or so, or the next few expirations. Some with the weeklies thrown in, but it really wants to look at the next 2 normal expirations. So in this case, it might be April and May, looking at the in-the-money calls and puts, the out-of-the-money calls and puts, and the average implied volatility of all those numbers. If I'm looking for something that's maybe 80 to 100 to 200 days out in time, I might not be too concerned with the IV over the SIV, because we know the near-term options, if it's a weekly 5 days out, 1 day out, of course, doesn't count today, it's already closed, 5 days out, 12 days out, 19 days out, those are going to be more responsive. Those options are going to be more responsive to movements in the stocks and near-term fears that might come up in the next couple of days. So if I'm looking at something this far out, I'm probably not overly concerned comparing it to the average of the near-term 30 to 45 days. The IV to HV is probably more what I'm looking at, or the Black-Scholes ratio of the 50-day. But if you're doing a weekly series, you're selling weekly calls, you're doing weekly spreads, then you might want to pay attention to the IV over SIV to see if your option is overvalued compared to the average implied volatilities of the near-term months. Okay, but if you're buying something that's far out, you don't have to worry about that. Now, when you're looking at spreads, Larry, one might consider that, hey, I want to look for a credit spread where the option that I'm selling is overvalued and the option I'm buying is undervalued, whether using IV over HV or the Black-Scholes ratio. Well, there's sort of a catch there, isn't it? And let's just go back to Disney again, and we'll look at the call side one more on the chain. And I'm going to add in some columns, okay? And what I'm going to add in here for our columns is that IV-HV ratio. I'm also going to add, well, the Black-Scholes number is there, but we want to see the Black-Scholes, oh, sorry, folks, the Black-Scholes ratio also. And there's the Black-Scholes SIV, there's the Black-Scholes ratio 50-day, and I'm also going to add the IV over SIV. Okay, so let's go ahead and submit that and refresh our page. Okay, so what was our first? Let's go April, yeah, let's go to the 18th, standard expiration, okay? Now, where I'm going with this is here's our values. This is the call, so let's look at a bear call spread. I'm not saying I'm bearish on Disney. Let's just take this as an example. Let's say with the stock at 114, I want to sell a 118 call and buy a 120, okay? Now, regardless of what the prices are, I'm thinking, okay, I want to sell something that's overvalued and buy something that's undervalued on a stock that has the same expiration and the options are 2 strikes apart. What do you expect to see? Most of the time, here's the implied volatility. As we saw, it's 1.7, 1.6, the IV over HV. So we're 70% overvalued compared to the stock's historical volatility, which is at 0.15, and we're at 0.2492, okay? But the short we would be selling is overvalued by 70%, the long is overvalued by 60%. The Black-Scholes ratio, it's 210% overvalued for the one we're selling, that's good, but then about 400% overvalued for the one that we're buying. And then the IV ratios, the Black-Scholes and the IV ratio compared to the SIV, the average around it is about even. So where am I going with this? Same expiration, same stock, 2, 3, 4, 5 strikes apart. It's very rare that you'll see the option that you're selling on the same stock be overvalued and the option that you're buying be undervalued. They're both going to be overvalued or both going to be undervalued. That's why diagonal spreads are very popular, because I could sell into this overvalued premium on Disney and then maybe buy a June or July or September series perhaps that's undervalued because it's further out in time. Same expiration of vertical spreads. If the option you're selling is overvalued, either compared to the historical volatility or compared to the Black-Scholes ratio, the one that you're buying is likely going to be overvalued as well. Okay? Still could be a good credit, still could be a good trade, but don't expect to find an option that you're selling that's overvalued and an option you're buying undervalued in a vertical spread with the same expiration on the same stock. Okay. Now, what that leads me to is let's go to that custom spread tool I mentioned, the profit and loss chart. Let's stay with Disney for a moment. And let's do a diagonal. Take that April 18th. Let's go to that 90 cents or so out of the money 118 call. Might sell that. I'm going to mimic a covered call trade. Let's say maybe I want to go out to September, 168 days away. And I'm going to buy the 100 call. All right, so we sell the 118, buy the 100. I could go further out to January if we wanted to, or further out in time. But here's a common diagonal spread. Okay, we're grabbing the midpoint here at 1690. It's a wide bid-ask spread, isn't it? 1575 to 1805. It's about $2.30 bid-ask spread. Reasonable return for what we look for in a diagonal. We know we have 100% risk on this position, but the stock would have to fall significantly to realize that. Now, what happens if the stock stays at the same price, perfect at 115 on our expiration day of April 18th? Well, they paid $16.90 for the call here. Let's go. Let's see here. What would happen if the stock stayed right at 115? Well, naturally, we get the decay on the position. But wait, something's not right here. Here we are on April 5th. And 13 days from now, if the stock stays at the same price, how would my September call gain from 1690 to 1736? It doesn't make any logical sense. It can't do that. We're going to see 30 or 40 cents of time decay, not a 46-cent increase in premium. How is that possible? Well, this is a computer. And a computer can only read what you tell it to read. So this is important for those of you that are sort of using power options, even if you're using diagonal spreads, and you're looking to say buy something that's 4 weeks out in time or 3 weeks out in time, especially around an earnings. So let's say Disney had earnings next Friday on the 12th. And I want to, or let's say the following Monday, the 15th, excuse me, April 15th, Disney has earnings. And I want to sell the April 12th weekly call and buy the 18th. So that when earnings comes out on the 15th, this short option isn't going to be affected. It would expire, and then I'm still just in a long call with a lower cost basis going through earnings. But then you look at it and you say, wait a minute, this has no risk on the position. This doesn't have a lot of risk on this trade. How can that be? Well, what's happening here? The system can only calculate the expected value of the farther option based on the Black-Scholes pricing model. And for options that are more than 30 days out in time, we're using the actual implied volatility of this option. So what does that tell me? What are the two things I can see right now where there is no way my September 100 call would gain 50 cents over a 15-day period if the stock stays at the same price? That tells me that because of this implied volatility, this option is likely overvalued right now. I'm sorry, undervalued right now simply because the implied volatility is too high. This number, stock being at, or I'm sorry, our 100 call being at 1736, theoretically, in 13 days, gaining 46 cents if the stock doesn't move in those 13 days, which doesn't sound logical, is because the system is basing it off the actual implied volatility of the option, which is really all you can do when you're looking at a theoretical price. So it's likely because of that wide bid-ask spread, maybe I would be paying closer to 18 and we'd be closer to 15, the bid price, in 13 days. Let's check it. Again, go to research, go to option research. We see that we have a highly overvalued option compared to the underlying stock volatility, but compared to the average of the 30-day options and 45-day options around it, it's about even. But see, here's another clue. The total range of implied volatility since this option was released on the market is 0.208 to about 0.2763. We're on the lower end of it. But I bet you if we go back and we put in that value, change the volatility to 0.2089, the lowest point for that particular position, still see a subtle gain here. But that again, remember, it's because we're getting it at midpoint. The ask price is up here at 1805. So that's sort of the trade-off there, that when you're looking at a position, you're analyzing your what-if scenario, and it looks like something is increasing in value that shouldn't if the stock doesn't change, it's because of this implied volatility number. And you might want to lower that to the expectations. And remember, too, it's more than likely with this bid-ask spread, I'd probably end up paying, I bet you, $17.30, $17.35. It's going to change the spread a little bit, drop it down to a 22%. But of course, now if the stock stays the same, and I hold it to April 18th, the short-term expiration, that's what I'd expect. Okay, so those are just some things to keep in mind. If you have a wide bid-ask spread, you might come across that situation where you see an expected value that's actually an increase if the stock doesn't move, if time doesn't pass. It might be due to the wide bid-ask spread that you more likely get filled at the higher price. More than likely it's due to that implied volatility. You want to use that option research tool there to quickly check what your total implied volatility range is, and then run the scenario again using the lower range of the implied volatility, especially if you're up near the higher. As I mentioned earlier, that really comes into play for a stock that's earnings if you're trying to create a spread position around earnings where you're selling before the earnings, selling an expiration before the earnings date and buying one after. The option that's after the earnings is going to have a very high implied volatility. And then when the earnings hit, you've got to anticipate that implied volatility is going to decline drastically. You're going to see a volatility crush. You have to factor that into the price. Quick example. Let's try to find a quick example, okay? Let's just go back to calendar call. I'm going to try to do a really quick search, okay? Before I do that, let me answer Larry's follow-up question, which is something that I usually follow up with. All right, I'm just going to go to covered call, and I'm going to go to search. So Larry's second question, follow-up is, for index trading, the question of over underpriced is irrelevant? Well, potentially, but it depends on what your expectations are. And I know the expectations can change. Sam had mentioned in a comment, of course, and he wasn't necessarily talking about spreads, but I wanted to illustrate that point with the spreads, that if you want to do a vertical spread of the same expiration, you can't anticipate selling an overvalued and buying an undervalued. But in the diagonals, I'm going to look to maybe sell an overvalued near term with a high IV-HV ratio or higher Black-Scholes ratio, and look for a Black-Scholes ratio or IV ratio of less than 1 on the option I'm buying, 6, 5, 3 months out in time. The follow-up to Larry's question, regardless of what search I'm using, let's just say I'm using the this one here. I'll stick with the in the money position. Let's say that but let's say that my specific search is looking for stocks that have a certain market cap, certain fundamental qualities, positive earnings per share growth, relative PE ratio, no earnings between now and expiration. And as part of my covered call trading plan, in addition to those stocks, I want something that maybe has a positive MACD signal trading above the 20-day moving average, and I want a minimum 2% return if assigned, going slightly in the money with about a 5% downside protection. These all have that. Going 42 days at a time, let's just change it to April for the time being, 15 days away. Okay. So I'll just take ATVI. This is not a recommendation again, but I could buy the stock at 47.29, sell the April 43 call. Oh, it's nowhere near my return goals. So here's a better one. This one here, Turning Point. I'm sorry, I don't even know what they are. 43.26, sell the 40 call, 8.8% downside protection, 2.2% return if assigned. Turning Point Brands, 8.4% downside protection. Okay. So let's say this matched, and I would set up the search to match my needs, stock above the 50-day moving average, other fundamentals, no earnings between now and expiration. And this one comes up. Now the question here, Larry, is it in theory, yeah, when I'm selling premium, I want to make sure this option is overvalued. I want to be selling into high premium. But if the stock matches the trend that I want, if the covered call matches what I want for protection and for percent if assigned, for my trading plan, do I really care if the market considers it overvalued or undervalued? My honest answer is no. I do not care. If the stock is in my price range, has the return I want, protection I want, matches the fundamentals and technicals that have worked for my trading plan and match my trading plan, I'm not overly concerned if the market considers it overvalued or undervalued. You know, when you're comparing two stocks that are almost the same price and one has a downside protection of 12% with a 5% return and the other has a protection of 10% with a 2% return, that tells you that that higher return one probably has more volatility because of an event coming up. Might not be earnings, might have just been recent as well. So that's the comparison you want to do. But to me, Larry, my answer is that if it matches my criteria for the trading plan for that strategy in my portfolio, I'm not overly concerned if the market thinks it's overvalued or undervalued, because that's the trade I want that has the criteria for the stock and for the options that has worked for me in my trading plan moving forward. Okay, so that's the direct answer to that. As far as does it matter if it's the indexes, Larry, or overvalued or undervalued? To me, in a lot of positions, it doesn't matter. Why was I harping on the diagonal spread so much? Well, I was talking about the diagonal spreads because that's the one I do pay attention to when I do my calendar call search, where I'm likely going to look for something where the the implied volatility range and the implied volatility ratio, the sell option divided by the implied volatility of the buy option, is greater than 1. Right? Because I want my sell option to have a higher implied volatility than my buy option. I'll look for that, as well as, you know, different things, delta ratio, and potentially the implied volatility range as well for my diagonals. Okay, so what I was going to try to show you real quick. I'm going to keep everything here for this default search and see if anything has an earnings date between now. I'm going to try to find it between now and the short expiration. I don't think this is going to work the way I want it to. It didn't think so. Let me go back to home. And I know we're in entering a new series here. Earnings announced today, GBX. All right. So I'm going to click the link there for view more earnings announcements. Hey, let's try BBY. That looks pretty good. Bed Bath & Beyond. Earnings coming out on the 9th. Okay. And so what I want to do now is we're going to go back to custom spreads. We're going to take BBBY. So I know something's coming out on the 9th. Shoot, that's not what I want, actually. I want something a little bit further out. But that's okay. We can still do this. So let's say sold the 5th and bought the 12th. Okay, so I'm going to do a diagonal of, let's say, buying the 17 call, and let's say we sold the 19 call. I know it's only 1 cent, but let's go ahead and do that. It would have expired today. And let's say we got, 18 cents, 20 cents for this one. And the 12th of April series, which is more affected by the earnings, is up at 192. So I cut down the cost by about 10%. Not quite 10%, but almost 10% to 173. And so there's my diagonal spread. Now, the volatility for that April 12th series is 0.7387. 74% implied volatility. Why? Because this series is going to be most affected by the earnings on the 9th. And again, what happens if the stock stays the same between, well, let's just clear that out. Let's just look at the long call again, but we knocked our price down to 173. So again, what could we expect to happen if the stock moves up just $1? I'm sorry, moves up to $20 on expiration of 4/12 or on the 10th, right after the earnings comes out. Well, it's going to show me a value of 108. It's almost a 50% return for a 2-point move, a $1.65 move. That sounds fantastic. But wait, this volatility on April 10th will not be 74%. The earnings come out on April 9th, sure, the stock could fall. The stock could move up. But this is going to have a crush. It's going to go back probably to normal, especially if it's only a 1% or 2% or 3% move one direction or the other. So what do I need to, what do I need to know? I want to know what is the range of this. This particular option, what is my implied volatility range? Okay, it's going to take a second. I'm sorry, we're at 5 o'clock. Not that that matters too much. What's happening is in the background, we're loading up all of the historical data. So it's reprogramming and recalculating that and trying to grab the historical table here because we show a chart on this research page. Come on. Let's see which one gets there first. All right, that's going to load for a minute. But let's just say that on average, while that's coming up for us, let's just say that the average implied volatility for this particular option, since it's been released on the market, is 0.35 to 0.73. Well, I might expect it to drop back down to 0.45 after the earnings. So with a $1.65 move right after earnings, yeah, okay, so it's still about $3 because it's close to intrinsic. But again, if it was something lower, we'd still keep it. Yeah, this is a bad example. I'm sorry, it's too close to expiration. I should have taken something further. And we will. Let's do, I apologize, let's do something further out in time. Let's see what May 10th is like. Sorry about that. Let's use the 17 call. Okay, and this one, it's going to be affected by our, see, it's not as high, it's at 0.68. So let's say on April 10th, we go up to $20. So should have used a better example. I apologize for that. All right, so we go to $20, $3.44. Now, we drop the volatility down to 0.25, which is the average. Give up 40 cents. So that's not as bad, but again, it changes the percentages. So you want to keep that in mind if you're evaluating any position going through earnings. You run the what-if scenario, make sure that you account for the change in implied volatility on the position using that research tab to see what the implied volatility range is as well. Okay. All right, so Sam's talking about he's in an Apple Bull put for next week, 190 to 187.5, and has been trading win. Okay. This is related to a specific historic position on the radioactive trading techniques. Jerry says, last year you took a married put on PENN. The stock dropped almost 30%. You did an income method number 12 and made 10%. Yes, so I did a certain adjustment on that to do that. And looking at the position on the weekly chart, all the technicals that I used showed the downturn in the stock when it happened. How did you decide what price to put the second put at and how far out to buy it? The best answer to that is to check out the video on income method number 12 that's shown in the Radioactive Trading Blueprint Owners and Fusion Subscribers archive webinars. And I think I even covered that later in another webinar as well for Blueprint owners. It's more of a specific question for Blueprint owners. We don't really talk about the specifics there on the Friday sessions for people who don't own the Blueprint. In essence, it was based on my expectations of where the stock would fall and how long it would take. And as you mentioned, I think even in the historical trading record for that trade, hold on, sorry folks. All right, so for Blueprint owners and Fusion subscribers, the Blueprint owners only webinars, there's the brief discussion here on income method number 12, the first one that Kurt put together. And then for Fusion members, there's a couple different ones as well. Is this the one where it's playing the bear side, 5 ways to milk your RPM? Fencing it in was one of the original ones as well. Okay, but let's take a look here at the track record. The real answer to your question, Jerry, there's no one answer. Okay, income method number 12, described in your blueprint, typically done best if you use the same expiration and a price where you think it's going to drop to. That's not always the best case depending on what is coming up with your stock and what has happened as well. PENN was from further back. Oh, no, it's right there. Jeez. Yeah, this is the stock that dropped 33% when I was holding it. I added income method number 12 here at 10.5. So here, you've heard me talk before, Jerry, about waiting for a confirmation. When I look at a stock chart, I'll review that real quick. I have a trigger point, so it's not just if I see one of my technical triggers move, it's when I see all three. So the description in the track record, this was from October 5th. I bought the stock at 33. And I bought an April 35 put for 420, which had a maximum risk, let's just take a look at that, a maximum risk originally 5.9% or 220. This was done on October 2nd. Now 3 days later, the stock had a trigger, and I write this up, took a big hit today, dropped below all three technicals, Bollinger Band, MACD, and the RSI, as well as the SMA 20, of course. And what had happened was on a previous position, PHM, I missed the signal. I didn't miss the signal, but I didn't think it was a confirmation, and PHM kept dropping. But I wanted to be safe with this one, so even though I was in the trade for 3 days, I decided to go ahead and buy an additional put. Okay, now, yes, I chose about a 40-day out, 45-day out, November 30 expiration because I didn't know how long the downturn was going to be. What I might have done at this point, I'm sorry, the stock was at 30.46. So I might have done is bought an April 32.5 or an April 30 and then continued the trade. But as it exceeded my downside expectations, and by November 6th, the stock was at 22.60, I decided to get out. I didn't want to hang on to it any further, and it might have even dropped further after that, but I didn't want to, okay? So I put in the extra capital to do it, and this was part of another discussion that happened back in 2018 where we talked about which is the best way to use it, okay? And that's Blueprint Owner's presentation at that time. So this one was because I happened to be 3 days in the trade and I wasn't sure how long the downturn was going to be, so I just took a short one for a cheap cost, slightly at the money, just right at the money, slightly out of the money when the stock was at 30.46. But then over the next 30 days, as you can see, it more than exceeded my expectations, made $6 on that put, $8 on this put, yeah, lost $11 on the stock, but it ended up being a 10% return on a stock that was down 33%, and I was long stock the entire time. Didn't see the need to milk it for anything more. 35 days, 10.3% return, take the profit and move on. So that's how that was selected. It was based, again, on what we talk about with the SIGA model. What were the conditions? I'd just been open in the trade for 3 days. What were my expectations? Well, the stock was going to move up, but in those first couple of days, all three of the triggers that I use to look to get into a position reversed, pointed to a downside. So I decided what I could, there's 3 ways I could have gotten the same or higher profits. I could have done what I did. I could have made another adjustment to the position to probably profit more. And then there's one that would have looked just ridiculous, but also would have worked better, but hindsight is 20/20 because it exceeded my expectations. So in that case, based on the current conditions, my expectations and my goals were not to take the maximum risk if possible. And if I expected an extended downturn of more than 5 or 7%, how could I profit on that? And I didn't think it was going to be longer than 30 days. And it turns out it was about 30 days, but that hit the profit target I wanted for the entire position, so I got out of it instead of trying to stay into it any further. Okay, so that's how we apply the SIGA model into that, and it's something I use actually for all of my positions. If I'm nearing a trigger point on my bull put credit spreads, I'll say, all right, well, what are my current conditions? What were my expectations? And what were my goals for the position as well? So what we're talking about there is all the information, the blueprint, the initial structure of the limited risk trade to control risk to 3 or 5%, as you saw with the open on that PEN position, and then the 12 different income methods and how to use them to take that position from low risk to less of a risk, and then potentially even no risk on the trade with still unlimited upside and the ability to still do adjustments, sell premium against the nested trade position that's already at single-digit risk as well. And that's what's available in the blueprint, and that's radioactive trading. Jerry, I'm sorry, I'm writing a note here as I'm speaking. I will try to find something for you. I know I did a comparison on a webinar for Fusion subscribers or Blueprint members back during the time of that trade with comparison values of what would have happened had I bought the April option, what would have happened if I had bought, instead of the November, bought a January option 2 months further out in time versus what I did. And we can look at that somewhat historically as well later on. But I know there's a presentation I did that not only didn't just showcase that trade and what I did, but comparisons to the other ideas. So again, it comes down to your SIGA model and which position would give you potentially the best outcome if the stock now matches your new expectations because it's gone from bullish to bearish. Another example of that, of course, is the recent one we looked a little bit at last week. Now, Blueprint owners and Fusion subscribers might judge me on this one in history as completely playing it wrong, and they're probably going to be right. But I, of course, am in a married put on TREX. I got into the position originally at around 72, and I bought the 80 put, and actually I think I bought a different strike put. Maybe it was the 85, and I've rolled it since then. Apologize there. Let's just see here. I'll go back to radioactive trading, look at my current positions. A 76, 71, and I bought the 80. And we sold to open an 80 call right off the bat. Okay, and now the stock's sitting at 4.8%, but you can see where the stock price is 69.92. So, what happened to that position that it got so ridiculous from 225 to today, in a 2-month period roughly? Now let's go to 2 years, 2 months, and it didn't save my indicators here, so I'm just going to do this real quick. All right, so we got in, back in February when it was at 76, right near the peak. And we talked about last week how we saw this first signal here with the MACD crossover, but it was still above the 20-day moving average, and it was sort of still near my purchase price and kind of nearing my expectations. Everything was still good, and the RSI was still flat. This wasn't a 3 confirmed signal, although the RSI was there. When this happened, it dropped below the 20-day moving average and dropped to the lower Bollinger Band. The RSI went negative. I should have probably bought the same July put there, but remember, I've got an 80. I've got this checked. This is where my floor is for the married put. I should have probably bought this one, maybe for July, but probably would have been better buying an April 70 put. Why? Because it would have cost less, and then if I caught it at this point, which I can guarantee you I wouldn't have, but if I had caught it at this point and closed it, that would have probably gone from $4 to $12.50 or something along those lines when the stock was at 59. Okay, so it would have made an $8 profit just on that extra put. What I probably would have done instead of mentioned to do with the July one here, And now as the stock recovered yesterday, positive MACD crossover, back to the RSI, crawling here, that's when I would have sold or closed that additional put. Probably wouldn't have had that much profit. If it was the July one, I would have had more profit on it. If it was the April one, I wouldn't. I wouldn't have caught this based on the indicators that I use. Now here's the different trend. What I probably would have done is manipulated this. What I also could have done, by the way, is at this point here, and what I was going to do today, but I didn't, is I could take the $8 or $9 of profit I have on my 80 put right now and lower my cost basis completely by buying a 75 put, and then still be able to do adjustments here at 75 and probably be bulletproof on the position. So I was looking for the numbers to get that to work right, and they didn't. That's why I didn't make that adjustment on the TREX trade today. But I have a strong feeling in the next couple days, even though I've only been in this position for 30 days and done one income method, that I'm probably going to be able to cancel the remaining 4.8% risk on this trade with 2 adjustments and still have protection in place. Didn't get it to where I wanted to today, but I think I'm going to be able to. So my put is only out to July, though. Already got some premium against it, not a lot, 90 cents. But the stock is now recovering. There are different ways I could have played this to be in a better position, but I didn't do it because it would have doubled my risk. So I took the chance of not doing it. But now that I'm seeing the confirming signals, I think there's an adjustment I can make to cancel all the risk in about 40-day time period. All right, so that's what I'm going to look to do next week on Monday, perhaps on Tuesday as well. All right. Looking at a question from Sam here. Still holding his shares of SPY at 211 cost basis. Selling 290 calls against it this week as that was worthless. Okay, so that's the best dividend play you're holding. Okay, I see what you're saying. Okay, yeah, so he's augmenting dividend plays, augmenting an SPY dividend play using the covered calls in the near term as well. All right. Okay, well, ladies and gentlemen, we're at 5:24 p.m. Eastern Time. I don't see any other questions that have come in. So if anyone has any last-minute questions, go ahead and send those in. Just want to remind you all, of course, whether you're looking at covered calls or long calls, buying puts, naked puts, or more. Oh, sorry. Remember, in the search tool, this is covered call. In the search tool, you can set up, do you want IV over HV greater than 1? It's looking for options that are overvalued, where the options implied volatility is higher than the historical volatility. So if you have an IV-HV ratio of 1.2, that tells you that the implied volatility is 20% higher than the stock's 50-day volatility. SIV is the average of the near term in the money and out of the money calls and puts, the average implied volatility of the near term in the money calls and puts. So you can still look for options where your near term series is maybe a higher implied volatility than the average of all the other options around it. Similar calculation, but a little bit different for overvalued, undervalued, the Black-Scholes Ratio 50-day. Comparing the actual trading price of your option to its calculated theoretical worth using the Black-Scholes pricing model. And again, a Black-Scholes ratio of 1.20 tells you that your option is actually priced 20% higher, overvalued by 20% compared to where the theoretical model shows it to be trading. And if you wanted undervalued, buying a call, buying a put, maybe as part of the diagonal spread, we're going to look for a ratio of maybe less than 1, buying into an undervalued option, and then of course when you're selling, greater than 1 to sell into an overvalued option as well. Okay. All right, so just wanted to review that real quick, and then of course we talked about the idea of comparing that implied volatility range when you're looking at a specific option that may have earnings coming up, BBBY for example, and when you see a high implied volatility and you see something that says, hey, if the stock stays the same price between now and a certain date, let's put in 0.85 for example. Yeah, it's still not high enough. Okay, I'll put in 1.1. That'll be ridiculous. All right, so you see something and say, well, wait a minute. in 20 days, if the stock doesn't move, there's no way this option can gain any value. Yeah, because you'd be expecting a volatility crush from some event. We'd have to adjust that accordingly using the option research tool. One more time, to see that total implied volatility range of this option and to estimate where it might be if it was at the lower range, if we're expecting a volatility crush because we're trying to do some kind of earnings play with two options or an option after earnings there. Oh yeah, Delta Airlines, yeah, was good today too. Sam's just commenting. So Tesla might be a good new position, but Delta was really good this week as well, I believe, and he's looking still in that Delta trade also. Okay, well, I didn't see any other last-minute questions come in, so let's just move over here for the time being. I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Now, any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do, of course, involve risk and may not be suitable for all investors. Well, that's why we're here also to try to help you with our educational materials and more. Now, remember, of course, if you haven't done so yet, you can just go to PowerOp.com, put in your name and email address, and you'll get access to a full 14-day free trial. You'll have access to all of the tools with the real-time quotes for 14 days. And after that, the subscription services start at $40 per month only for the end-of-day service. And it's still only $60 for the delayed service. Every time you run a search, view your portfolio, look at those research tools we looked at today, or run the what-if scenarios on the profit and loss chart, numbers are updating every 15 to 18 minutes. And then, of course, we do also offer a real-time service and access to the historical tools and historical search capability on PowerOptions for different price structures as well. Now, if you want to check out some other education this weekend, remember you can always go to the blog.powerop.com. You can visit us on the webinars page. It's just powerop.com/webinars.asp to view some of our other recorded materials on the different strategies. Remember, we're always available on YouTube as well. You can just check us out on YouTube at PowerOptions. Now, if you do think of any questions later on this week, because I didn't see any last-minute ones coming in, remember you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. Please feel free also to call us during market hours at 302-992-7971. And of course, remember, trial members and subscribers, you can schedule one of those coaching sessions at any time. Essentially just a 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Well, I covered a lot of information today and some more complex stuff regarding the implied volatility as well. And as I mentioned, Jerry, I'll take a look for, I know I did a presentation somewhere on the PENN decision-making processes in addition to what was shown there in the briefs for the Fusion subscribers and the historical trade. And I'll look at that as well for you to try to find that and send that to you. On that, ladies and gentlemen, thank you for your questions for today. Thank you for spending your Friday afternoon with me. Get out of here. Go have some fun. Go enjoy the weekend. We'll see you soon next week for some more live presentations, of course, and be back on Friday as well for our wrap-up at 4:30 Eastern Time. Take care, everyone. Have a good weekend. Good night.